Robert Kiyosaki holds $1.2 billion in debt on purpose, and every morning he wakes up trying to figure out how to get into more. If you were raised with traditional financial advice, that statement probably turns your stomach. We are taught that a good person pays cash, lives below their means, and races to pay off the mortgage so they can finally be free and clear. But in the current economic reality, standing free and clear with a balance of zero is the most expensive position you can take. Reaching zero only marks the starting block for a game the wealthy have been quietly playing for decades. The rules of money flipped on a Sunday evening, August 15, 1971. The US dollar was officially taken off the gold standard. In a single announcement, the money in your wallet transformed from a claim on a physical asset into a paper IOU based entirely on debt. This shift created a punishing environment for anyone trying to save cash. Since that day, the dollar has lost roughly 95% of its purchasing power. Inflation works as a relentless, invisible tax. It quietly confiscates wealth from the average citizen who does exactly what they were told and tries to save their way to retirement. Since this melting of currency is a feature of the system rather than a mistake, anyone continuing to save cash is forced to choose between watching their wealth evaporate or finding a way to sit on the other side of the table. The wealth-building mechanism starts with a tangible, productive asset. Let's look at a $500,000 apartment building. When you buy this asset, you don't use your own cash for the whole thing. You use the 80-20 rule of leverage. You put down a fraction, say $100,000, and the bank funds the rest. If that property appreciates by 20%, the total value climbs to $600,000. Because the bank's loan amount stays fixed, that entire $100,000 gain belongs to you. You just secured a 100% return on the cash you physically invested. By using the bank's capital, your remaining cash isn't sunk into a single property. You stay liquid, holding reserves so you are armed and ready when the next opportunity appears. The bank puts up the vast majority of the capital and absorbs the lion's share of the risk. But as the borrower, you keep 100% of the upside. Jump forward a few years to see how inflation treats the property's balance sheet. This chart shows how a fixed-rate loan behaves over time. As the dollar loses value, the cost of living, including rent, moves on an upward trajectory, but your fixed mortgage payment remains a perfectly flat, frozen line. That expanding space between the rising rent and the frozen debt flows directly into your pocket as pure cash flow. The tax code accelerates this process. Because the government wants to incentivize housing and jobs, it rewards borrowers with massive deductions for mortgage interest and the depreciation of the physical asset. Inflation, the force melting the savings of the middle class, is actively paying down the rich borrower's loan using cheaper future dollars. When an asset appreciates, amateurs usually make a fatal mistake. They sell it. This immediately triggers a massive tax penalty from the government. The wealthy refuse to sell. Instead, they borrow against the asset's new equity, pulling out cash entirely tax-free. They take that newly extracted tax-free debt and use it as the down payment to acquire a second property, repeating the exact same process. This creates an infinite machine. The original asset never stops generating income, and the owner continuously extracts wealth, all while keeping the taxman's door permanently shut. Attempting to run this playbook without understanding the strict difference between the two types of debt is financial suicide. There is bad debt, which acts like a wolf. These are credit cards, variable rate loans, and money borrowed to buy cars or vacations. They drain your pocket every month to pay for things that immediately lose value. Then there is good debt, the watchdog. This is long-term, fixed-rate debt tied exclusively to productive assets that generate enough incoming revenue to pay the loan for you. Success requires the precise combination of controlling cash-flowing assets through fixed debt, while the underlying currency loses its value. In an inflationary system, wealth relentlessly moves from those holding cash to those holding productive assets financed with fixed debt. This migration flows away from those doing what they were told was responsible and towards those positioned to benefit from the dollar's shrinking value. The single most vital skill for surviving this system is identifying the strict difference between an asset that pays you and a liability that bleeds you. The money presses will never stop running. The only decision left is which side of the table you are going to sit on.